So as I was saying, my name is Edward. I work for the EBN network as a project manager, one of the implementation partners of the InnoRate project, and I'll be today's moderator. So I hope everyone is having a fantastic morning. I really look forward to this workshop. I think it's going to be super dynamic, and we've got the presence of two great experts today. So I really look forward to this session. And with this being said, I would just like to introduce you to the EBN Congress. As you might have seen, this InnoRate Investment Readiness Workshop is part of the larger, is implemented in the framework of the EBN Congress. And it's the ideal sort of point of entry to meet the EBN community. So for those of you who don't know the EBN community and the Congress, then here's a quick introduction. So the EBN Congress is the largest annual event that we organize every single year. And basically what we do is to really try and connect the entrepreneurial innovation stakeholders from the community. So when I talk about these stakeholders, we can really see a point of diversity in our member group. So our EBN members are European incubators or accelerators or other types of business support professionals that work on a day-to-day basis with startups and SMEs. So you can count on the presence of a lot of other startups and SMEs that will be there during the Congress as well. We'll have some corporates, we'll have some investors, and we'll have some institutional partners such as the European Commission. The idea is really to try and foster the exchange of ideas and co-learning on themes that directly affect yourselves, startups and SMEs, and the wider innovation ecosystem as a whole within the European context. And as I mentioned at the beginning, it's really the ideal place to meet the EBN network. So if you haven't registered for the EBN Congress, this is a kind invitation for you to do so. You can either send a small email to my colleague, Evelyn, and either you go on the EBN website to register. You can mention that you're part of the InnoRate project, and you'll be able to attend free of charge. So you can attend to all the different panels, debates, workshops, and also a virtual matchmaking platform, so you can connect with other types of stakeholders there. Yeah, I kindly invite you to do so. And with this being said, let me just quickly delve into the introduction and today's agenda. So we'll have a general introduction to InnoRate, who's kindly sponsoring this workshop, after which I'll introduce both our experts that are present today. So David Gill and Maria Carolina Romero. It's fantastic to have them on board, and I really look forward to their masterclass and the exercise. After that, the experts will delve into negotiation skills for entrepreneurs. So they touch base on several factors, the Berkus and replacement value, rule of thumb for entrepreneurs, term sheets and negotiation basics. And then obviously we want to try and make the session as dynamic as possible. So should you have any questions, feel free to pop them in the chat, and we can relate them directly to David and Maria Carolina. We can or not have the virtual coffee break. I think it depends a bit on our experts. If they would like to have a small coffee break, that's perfectly fine. If not, we just power through the exercise as well. And then we can have some concluding remarks at the end. So as I was mentioning, I'm super happy to introduce you to both our experts today. So we have David Gill, who's the Managing Director of St. John's Innovation Center since 2008. On top of that, David is also the Non-Executive Director of ET Capital, which is a fund that manages a series of funds specialized in science-based businesses in the UK. He's also a Sloan Fellow at Stanford Graduate School of Business. He's an official visitor at the Institute for Manufacturing at the University of Cambridge. And he has worked in corporate finance for both US and UK based banks. So it's a pleasure to have you on board, David. And then on top of that, we also have Maria Carolina Romeo, who is with us today and who is a business angel since 2002 with a significant portfolio of around 10 plus investments in high-tech startups around Europe and the MENA region. She's an active investor, trainer, coach, and mentor. and focus really on designing and developing the investors community and entrepreneurship sustainable ecosystem around the world. She's a partner at Efino, and she leads the learning investor programs in Lebanon, Jordan, and Egypt. And obviously, Maria Carolina has led portfolio project and investor groups at Go Beyond Investing. So as you can see, we've got really quality experts today. So again, a massive thank you for the time you're providing us today morning. All right, so as I mentioned, I would like to quickly introduce you to the InnoRate project, which is a EU-funded initiative under the Horizon 2020 program, which is the framework program of the Commission that is focused on research and innovation. The main objective of the InnoRate project is to drive the move towards the development of a EU financial system in which tech-driven SMEs such as yourself with high growth potential have easier access to financing solution required to scale and grow. So within the framework of the InnoRate project, we've developed a service platform that basically links innovative SMEs on one hand with investors. And this is done through an objective and forward-looking technology rating innovation methodology. So as you can see from the slide, InnoRate is being implemented by a total of 9 partners. And the way we like to describe the InnoRate project is that InnoRate brings innovation to finance and finance to innovation. So should you want to have more information about the InnoRate project, if you're not already registered on the InnoRate platform, please feel free to reach out to us and we'll be more than happy to have a quick call with you to introduce you to the platform. And with this being said, I would like to stop sharing my screen to allow Maria Carolina to kick off the first part of the masterclass.
Edward, thank you so much. So let me see if I can share my screen now, if everyone sees it.
All right, you can put it in presentation mode. Fantastic.
Thank you.
Great.
Okay. So thank you so much, and very happy to be here. A little bit of the introduction that why I'm always so happy to share this type of knowledge is because I have also been an entrepreneur like you guys. I have led 3 startups so far and 2 exits, and I have been in the same moment, which is critical, that is about the negotiations. And so when EBN told us let's come in, I was delighted with David to build this for you, because I think that what we are going to sincerely today is sharing, more than teaching, is sharing those lessons learned and those best practices. So a little bit of where valuation comes in and the terms negotiation. If we go back to the life investment cycle, when you guys are running your businesses and so on, normally you present your company and then its entire performance of the due diligence. And then afterwards, we normally, let's say the investors, we end up negotiating valuation around 2/3 in terms of the timeline. But the beauty, and today maybe what the invitation comes from both of us, is that you start, even though you don't need to wait until that process starts in order to understand the valuation of your company or understand what would be those terms to negotiate. Because by yourselves understanding how to do the valuation of your companies and what would be a fair agreement for you allows you to be better positioned to actually get into all of these negotiations that, let me tell you, I haven't myself as an entrepreneur and as an investor, I have not met the first individual who has exited their company only after the first financing round. This is a process that normally takes 3 to 6 financing rounds before exiting. Therefore, the more knowledgeable and educated you get in all of these negotiations, in all of these processes, the better it would be for you to actually drive your financing strategy and get to a successful exit, like sincerely looking from exit backwards. So what I'm trying today to share with you is that despite how early stage is your company, because I remember the very early days when people were telling me, okay, how much worth your company? I didn't have a clue because limited information was at that time. I appreciate very much to have this methodology. So overall, we have in total 7 methodologies, but even more, like it's in total, it's like around 15, but the ones that entrepreneurs and investors we use the most at this very early stage are these 7. Today, due to the, let's say, the time constraint, and most importantly, because we have this exciting case study afterwards, I will focus in the ones that you will need in order to, let's say, navigate in terms of valuation, what is important. Okay, so a little bit of where you are. So as investors, we normally design our investment strategy, we source, and actually before investing and build is exactly when these negotiations happen. Very important here a little bit, and I'm sure many of you know this, but it's very good sometimes to remember, it's not the same talking about pre-money or post-money valuation when we are talking about it, okay? So best practice ever is pre-money valuation, and simple reason is because all of us, we understand how much money do we need to fund our company, like and then in reality is how much actually we can get of funding. Like there's no guarantee that if, for example, you will say my company needs 300K or 600K, you will be able to get that funding in a limited time. So that's why my recommendation with everyone is whoever you start the negotiation, always start talking about my pre-money valuation. And just going back to basic terms, when we talk about pre-money is the valuation of 100% of the company before the investment is made. When we talk about the money, and careful here, it's not about the ask, no, how much money are we willing to raise? We are talking about the cash that actually is invested in this round. And when we talk about post-money valuation, we are talking about simply the addition between the pre-money valuation of the company plus the money that has been invested in the present financing round. That is equivalent to the 100% of the company after the investment is made. So, and again, as I'm a little bit cross-border investor, it is true that it is not the most common practice globally. In Europe, we normally talk about pre-money. However, I always make the emphasis, when I was an entrepreneur, when I am an investor, are we talking about pre-money valuation? Here in Middle East, I'm based now currently in Dubai, they are normally talking to me about post-money, which I think is very risky because no one can guarantee that you can actually get your entire financing in, let's say, in one tranche, specifically nowadays with pandemic and so on. So that's, let's say, lesson learned one that I wanted to, and it's super basic. Everything that I will share with you today is basic, but will make your life easier in terms of negotiation. The second very important thing to know is, as all of you know, sometimes time and cash are constraints, and we need to compensate our individuals, like the management team, our consultants, people at the board, and so on. And the way that normally companies do that is by actually having an employment stock option plan, or if we go more in legal terms, to issuing a conditional capital, okay? And then that's why I always ask, when we are talking about pre-money valuation, I always add this fully diluted. So the entrepreneur, when he answers me, fully diluted, then I understand as an investor that there's an employment stock option plan in place and that I'm not really investing. So what is my real number of valuation that I'm investing in? So let's see a little bit with a small example here. We go to a founding round. Let's take an example whenever I was building my last company in Switzerland. So for founding, I need a capital. I needed sincerely to invest 100,000 in order to do what we call a company that is legal entity that can receive external shareholders. Okay, so for that one, in Switzerland, it's called an AG. So founding, I had the 100,000, that was my main investment, that it was put among all of the founders. We were 3, we had a share value, nominal value, EC1 of 1. So then of course, the number of shares that I needed to issue were 100K. So total number of shares at that time, 100K, pre-money valuation, and we were simply founding the company was 0, and the post-money valuation was 100K. Now, careful here. Because we knew we needed to compensate people, we issue our employment stock option plan. So meaning there was a 10K that I'm not using today, but me as a founder, I have the faculty to use to compensate individuals. And then afterwards comes in the negotiation about vesting period. Meaning if I was hiring at that time a great CMO, I was telling, okay, your compensation would be half cash, half shares, but you will only have access to the entire, let's say, package of shares after 3 years, and in this way, okay? So this is important to understand. So round one comes in. At that time, we needed an initial investment of 200,000. We discussed, we did different of the methodologies that I will show you afterwards with the investors, and we said, okay, we all agree that the pre-money valuation of the company based in the methodologies that I will walk you through shortly is going to be 1 million. And okay, great. And then the share value is going to be 10. So afterwards, I am issuing 20K. So total of new shares will be 120K. Okay. So this investor, if I didn't disclose that we were talking about fully diluted, he will be thinking that he's investing into a pre-money valuation of 1 million, and that actually the total shares and everything was about 120K. What happened in reality is, yes, I'm doing all of that, but I have an ESOP here of 10K, which means that whoever was coming in was not coming in at a valuation of 1 million, was coming at 1.1. And it is, for example, it is not the same of having the 5% of 1 million is not the same percentage of 1.1. I was going to be more diluted. This is important specifically for the exercise that you're going to do. So it is very important that you are, whenever you're negotiating, so that there are no surprises, talk about pre-money valuation. If you have employment stock option plan that you are authorized through conditional capital, you talk about fully diluted. And this is exactly how the entire negotiation goes. And then in the future, you will not have any investor upset telling you, but how on earth I thought I had the 5% of 1 million, not precisely the less percentage that I have over 1.1, okay? So that is something very basic, but very important, and you will see it in the exercise today. Please let me know if there's, as I cannot manage very well the chat, I don't know if Edward or Evelyn, if you see any question popping in or whatever, just let me know or stop me, and then I will address it.
Sure. No questions so far on the actual subject of the masterclass.
Pre-money and post-money and so on. Great.
Yeah, I'll update you if we receive anything.
Thank you. So I'll go quickly because I know the time is limited to in 3 very basic but powerful valuation methodology. So when little information is available, when you guys are starting sincerely after founding ground and so on, we normally talk about what is the rule of thumb methodology for the investor that, let's say, the proper name is called the Berkus methodology. So normally what you do is you take 5 components of your business that you can actually value. This arranges the one that I'm sharing with you on the right. Due to COVID, there are several sectors that have been impacted positively and others negatively, meaning I am seeing a variation between 20 to 30% low, for example, for companies in travel, leisure, and others. And for example, in EdTech, Agri-Tech, healthcare, I'm seeing an increase in these numbers of valuation. And with pleasure, I can share, let's say, the last statistics that IBAN just issued. So normally what you do is to take, let's say, 5 dimensions. Here I'm proposing you these 5. If you go and research more of the Berkus methodology, you will find more. But for example, for a sound idea, meaning for it's an innovative idea, you're answering a problem or solving a need, it's actually between 100K and 500,000. And again, these are ranges, and the currency is kind of the same in euros, USD, and Swiss francs, despite, of course, we know that there's an importance difference in the rates. For a prototype, if you guys are building a product or actually are going for a platform and so on, it is not to have a prototype, beta prototype, and the rest. So that's why exactly how advanced you are in terms of that development can come from 200K to 1 million. In the terms of the team, and here I saw, even though I have been in this journey, now it's a time, I can tell you that this, at the very end, it's a people's person business. I prefer a team A with a product B than a product A with a team B, because it has been proven it's super difficult to make it happen. You guys have to pivot your business models several times in order to get right the customer fit. So for us, team is extremely important. So normally it's like you value, okay, the members of your management team, how much, let's say, is worth annually, like the salaries and so on. If you have a serial entrepreneur as a founder or part of the management team, we investors love it because the individual has already walked the journey, understands the challenges, has done and has had success or even failure. Is as important as to have the success. And if you and how that team is well surrounded. So how is the board? How is the governance? And I know that many of you are in a very early stage, so we are not expecting, let's say, a proper board of directors, but definitely, yes, an advisory of individuals who could help you navigate, because it's not an easy journey. Then, for example, you can take the rollout and the sales. How much are actually the sales? How much are the sales pipeline? Here, one mistake that I did in my early years as a founder, I thought, oh, I have a lot of pilot projects. And for me, that was in my mind equivalent to sales. And it is not. Let me tell you, after having through different startups, a pilot is great in order to get that customer validation, but it's not equivalent to actually getting sales directly. So that's something important. And then for strong protection, for example, if you are in a vertical that actually you can patent everything, fantastic. Many of you are not. So for example, the brand awareness, the traction that you get and so on, that is extremely important, the recurrent clients and so on. So that could be the one that you can use. The other one, to be quite honest, is the one that I love the most whenever I'm negotiating with an entrepreneur. And is that no one knows better the business than yourself. And on top of that, no one knows better how much is your willingness to get diluted. So we normally do this vice versa. I use it with many of the companies in my portfolio, and it works pretty nice. And then afterwards, we work around the valuation. Having said that, valuation is not a final number. No, we normally talk about ranges. And that's why you get these valuation methodologies in order to get ranges. Example here. The entrepreneur would like 300K, but seriously for that 300K that he needs, the amount needs to actually move one company from one stage to another stage of development. The founders do not want to go, like seriously do not want to give more than the 20%. So what we do is a very simple math here. 300K plus 1/5, so sometimes 5, that is exactly the 1.5. Then you subtract the amount desired by the entrepreneur, that gives you a pre-money valuation of 1.2. Easy. And normally, what that has helped me so much, because as I have been a founder, when I'm an investor and I see the entire thing stock, so I go back to the entrepreneur. Let's go back to basics. What is the amount of money? So that's why you guys need to understand very well how much is the amount of money that you are willing to raise and that the business really needs at this stage of time. And then how much sincerely be stuck with oneself about dilution, and afterwards things can work around that. I'm not saying that all the time investors will go with these, but it is a very pure conversation that actually creates a lot of bonding, and we are, let's say, all connected at the same level. Then in addition of the two, this is the last one that I will recommend at this stage, and it's really the replacement value. And if you guys have to start from scratch, you close your eyes. This is only as an indicative, and you say how much it will cost to have the company as it is today. And you go to your numbers and you go to your Excels and so on. And actually you can show, and it's extremely powerful. And the unbelievable thing that happens, not all the time, but 70% of the times, is that this replacement methodology, I don't know why on earth, is actually very correlated with what you guys want to be diluted. So it's seriously to think about all of the cost, every single thing to rebuild everything afresh. And then also very important to understand and be humble that there's a learning curve that for you guys might be more costly than for the other generations to come. So just to have an adjustment there, and that allows you to actually understand your whatever achievement you have done so far, every single cost that has been like the bone marrow of the business in one. So I stop here, David. I hope I didn't take much time from you. And yes, I'm looking forward to yours. So let me just stop sharing my screen here.
Well, thank you very much indeed. That was a really clear introduction. I have to make sure that I'm showing the right screen.
Yeah, you are, David.
That's excellent. Thank you very much. I'm going to pick up, I hope, pretty much exactly from where Maria Carolina left off, and talk about, let's say you've now got to the stage where you've a pretty good idea of how much money you need. You've made your case to investors. They've accepted that you're a very strong candidate. And what they now do is put in front of you a term sheet. And term sheets are not quite the same as a contract. They're almost an agreement to agree, in the sense that it sets out at a high level the key terms on which the investors are prepared to put money into the company. And when you first receive it, there will still be a fair amount of room for negotiation, as you saw in one of Maria Carolina's earlier slides about the stages of negotiation you go through. Things that I think are really important about term sheets are understanding that they aren't the final version, and they provide the framework for several other legal agreements that will come out of this. But you do want to get the heads of terms right, so that you know that you're all moving in the same direction. I'll come on in a moment to what the heads of terms are likely to be, but to give you some examples of what the other agreements are likely to be, the terms on which the money goes into the business would be the investment agreement itself. And that would say how much, what type of security, that kind of thing. On top of that, and separately, there is the shareholders agreement, which is likely to give the angel and venture funds rights on the governance of the business after the money has gone into the company. And we will be talking a fair bit about that in the next 15 minutes, and it does come up in the negotiation exercise as well. On top of that, not necessarily, but very often, the investors will want to be able to regulate what the key people for the business, the existing founders that they want to hang on to, the key hires who come up in the near future, what their terms of employment will be. Because picking up a point that Maria Carolina made, it really is about the team. And if I, as an investor, think that you are an A team, I want to make sure that I've got your full attention and you are giving your full attention to the company. And finally, depending on what jurisdiction, what legal system you operate under, the likelihood is that at this stage, when investors come in for the first time, they will ask their lawyers to review the Articles of Association, the foundation document. In other words, the basic rules that govern the running of the company, regardless of the additional agreements such as the shareholders agreement. Other key points about the term sheets themselves, they're not usually binding. There is a sense that you're kind of on your best behavior. You can't walk away from a term sheet if you've started negotiating. But terms that can be made binding are confidentiality, and that's there to protect you as much as the potential investors. Exclusivity, it's very likely that investors will say, if you sign this term sheet and we start negotiating in earnest with you, then you give us a period that could be a month, it could be 3 months, in which you won't go and talk to other people. So that's something that's there to protect investors, so that you can't do what's sometimes called shop the term sheet. You've had an investor group A come along with a term sheet you quite like, but you go back to investor group B and see if you can get better terms. The one to look out for is going to be the payment of costs. As will probably have come across from the slide that Maria Carolina shared with the timeline and the amount of effort that goes into the due diligence after the issue of the term sheet itself and before money changes electronic hands, there is quite a lot of work to be done. And probably once you get to the venture stage as opposed to the angel stage, funds will put in as a default that they want the company to pay the costs of due diligence. I think it's perfectly legitimate to negotiate on that. In my experience, angels are a lot more amenable. Angels would probably say each side will bear its own costs. So if the angels have been using a law firm, the likelihood is that they've got the law firm on a retainer and they keep their own costs low. But watch out for that one in a term sheet, because it could be one that will affect the relationship between you and the investors during the negotiation. Moving on to what is likely to be in the term sheet itself, It can be fairly extensive. You know, it can cover several pages. But the things I think you would pretty much always expect to see, some of it seems really obvious, but lawyers put it in to make sure there is no misunderstanding. In a way, this is picking up the point that Maria Carolina made earlier about, are you talking about pre-money, post-money? Have you included the employee share options and so forth? The approach that the investors will take is never assume anything. Make sure you've covered all the bases, make sure you've made clear what it is that you want in the agreement. So even things such as the parties would be spelt out. And on somewhat bigger deals, or for instance, where you've got one venture fund that is proposing to put in, let's say, €1 million, but it's bringing in other venture funds who are also putting in, across several of them, another €1 million, it would be common to say who the lead investor is going to be, and to make clear that the lead investor is the person that you should be negotiating with. Another one that you really do need to look out for is the financing structure. And it's not just the amount of money. That's probably the thing that you've been focused on most. All valuation, which is what we'll come back to in the exercise, using the outline that Maria Carolina has just provided, but also what's sometimes called the series. In other words, what type of share is it going to be? Is it an ordinary share? Is it a preference share? If you're in a third, fourth round of investment, is it a series 2 preference share? Does it have rights that are better than the earlier preference shares? That kind of thing. The conditions usually cover the due diligence, which has been touched on already. Service agreements, something that we talked about as the other contracts will have to go into. And wanting to know about the ownership of your intellectual property. Also, whether there are any third parties who have a say in this. And a common one, I think, in the world in which most of us operate today is where, for instance, you are exploiting intellectual property that has come out of academic research. What rights might the founding or sponsoring university have? And the sort of thing I'm thinking about there is quite often a university tech transfer office might have granted you, as the researchers, a non-exclusive but revocable use of the intellectual property. In other words, you are allowed to use it, but you're not the only ones. And the revocability means that if something goes seriously wrong, including if your company goes out of business, then the university calls back the intellectual property. It doesn't form part of the assets to be distributed on a liquidation. You'll be pleased to know that there will usually be dates setting out a clear timeline, and that's there for both sides protection, really. All of you want to move to a conclusion, so there will be likely milestones along the way and an expiry date of the term sheet itself. Moving on to the type of security, this picks up a little bit what I was talking about series beforehand, but in many countries these days, to encourage high net worth individuals to get into the angel market, there are tax schemes which provide privileges for investors who put their money into early stage unproven businesses. And those tax privileges can be that, for instance, they can set aside a certain proportion of the money that changes hands this year against their tax bill this year, and or at a later stage if the company does really well and it leads to a capital gain, then the capital gain for those investors will be subject to a much more generous regime than normal capital gains. It could be that you get half the usual tax paid or even no tax paid. And what matters there, I think, particularly when you're negotiating with angels, is to know what are the rules that apply and to make sure that as far as possible, without distorting the fundamentals of your business, you do conform with the regulations that would enable your angels to invest under a tax privilege scheme. I'm just opening up a short footnote there. Yesterday afternoon, I reviewed the final set of proposals that have been sent to me by a university spin-out, not from one of my own universities, I hasten to say, with whom I've been negotiating for quite a few months. And because they can now assure me that they qualified under the UK regulations for the Seed Enterprise Investment Scheme, under which I get back 50% of the money I invest in the company, I finally agreed to sign the contract, and the money will change hands next week. So that made a big difference to me. I think it makes a big difference to a lot of angel investors. And finally, for my main heads of terms, I think you probably expect to see a clause saying what the money is to be used for. And that will refer back to what your pitch said. You've said you need €500,000 to get to the stage where you've reached your first 10 clients. And to do that, you need to recruit 3 more coders and a marketing manager, that kind of thing. It would be normal to have that at a high level spelled out. I think the more that the investors try to micromanage in the term sheet, the more you should be a little bit concerned that perhaps they won't give you the flexibility you need. But likewise, if they don't give you some guidance about how money is to be used, probably they're not focused enough. I would say, in summary, that once you receive a term sheet, if up until now you haven't been taking professional advice, then now is the moment to do so. And I say that because investors see term sheets every week. They're used to negotiating them. They're used to what the clauses mean. They know what the hidden traps are. It's very unlikely that unless you are an entrepreneur who's already had 2 or 3 successful startups, unlikely you've got that experience. And I think probably the advice you need is a combination of the legal advice so that you know what it is you're signing up for. That would include not just the investment terms themselves, but what you as the founders might be committing yourselves to in terms of employment contract. You need to understand also some of the commercial or financial implications of things like preference shares, anti-dilution clauses, which would come in if a second or third round of investment is required. It's almost certain that the investors will want to protect their position, their percentage ownership in the company. I'd also say that before you get to this point, if you've got the time, it makes you a lot more credible, and it will save you a great deal of stress if you've already prepared a full due diligence pack in consultation with, let's say, your non-executive directors who might have done this before and your lawyers. And the due diligence pack is likely to include everything from your existing cap table, your articles of association, your patents, your main commercial contracts, the employment contracts of your key people, even down to things such as where you rent premises, what are the terms of your lease, and obviously also you need to cover things such as the potential litigation. So if somebody has been threatening to sue you for a breach of their patent, you need to put that in as much as you need to put in what is your own patent. And the more you can do that, the more you're going to save yourself a lot of trouble and a lot of anxiety later, particularly on things such as putting capitalization tables together, which tend to be, frankly, a mess with a lot of early stage companies, and not surprisingly, because it's not top of mind when you're first setting the company up. And it also makes you just look that much more convincing to investors if you can answer the questions as soon as they arise. This then takes me on to preparing for the negotiation itself. And I'm sure many of you have done negotiation training before. I tend to come back to this little framework for ordering my own thoughts, which is that if you've thought it out with your team beforehand, you know for you what your best outcome would be. You know how much money you need, how long that will last you. You've got a reasonably shrewd idea of how much equity you will have to part with for getting that amount of money into the company at this early stage. And it has to be realistic, and you have to have the arguments prepared so that you can defend that. On the other hand, you have to think, well, it's unlikely in the real world that you will get the best outcome you really wanted. So how far down can you go before you say it's really not worth my accepting this offer? And that's sometimes called your best alternative to walking away, or your best alternative to no agreement. So your BATNA. And I would give an example there. If you know you need €500,000 and you need it within the next few weeks, otherwise you'll have to stop the company. And you've been talking to 12, 15 investors, and one has now come up with a term sheet. And the term sheet takes a higher percentage of the company than you thought you wanted to part with, but it still leaves you in control. And probably you still haven't reached your walk away point. So that's where you should probably look at the non-economic, the non-financial terms of the agreement to see whether there are any adjustments you can make there. Important things for you to think about before you get into the negotiation and as you prepare this framework, as you work out what your BATNA is. I'm sure many of you have already been introduced to the idea of the burn rate. Your burn rate is your negative cash flow, and it's often expressed as a monetary amount per month. For the sake of argument, let's say that you are burning a net 50,000 euros a month, and you've only got about 120,000 euros left in your bank account. You know that you've got roughly 2 months to raise the money, and if in the next few weeks you're making no progress, you need to talk to probably your non-executive directors and your legal advisors about how can you do an orderly wind down of the company so that you don't end up trading whilst insolvent. And that leads me to the other framework, which might seem obvious, but it's often forgotten, I think, in the sheer busyness of startup life, which is the longer you've got to negotiate to raise new money, the greater your bargaining power. And we often see it that when companies are down below a couple of months, they are almost getting desperate for funding, and their ability to negotiate good terms, particularly the good non-financial terms, will be really quite constrained. So good preparation is key. I can't say that there's any real rule of thumb. My experience in the past 2-3 years has been that at the really early stages, investors are prepared to put in an amount of money that will cover anything between 1 year and 2 years. And that probably means that at 6 months into having received your last round, you're already thinking about your next round. And again, as a rule of thumb, we have in the past 3 months seen deals close in under 2 months, but generally speaking, they're taking about 6 months to close. So that could depend on your sector, that could depend on the geography, but you do need to prepare a fair way out in order to be in a strong position. My next point is that it isn't just the investors who perform due diligence on you. It really pays off to perform due diligence on your investors. And part of that is making sure that they will be a good fit for you. The first element might seem obvious, but it's one that a lot of entrepreneurs forget. Are they in the right sector? If you're biotech and they only do robotics, it's unlikely. Do they invest down at the stage that you are? Let's say that you are currently a sort of top end of seed stage, and that might vary from sector to geography, but you're 1 to 2 million euros, let's say. You're not yet a Series A. Will this fund or will this syndicate invest down at that size? Another key one is it's quite likely, if you've been doing your projections, you know that even if you only need 500,000 today, you're going to need 2 million in 2 years' time. Would this group of investors have the deep enough pockets to be able to follow through and invest in the second round for you? Related point, particularly with a venture fund rather than with angels, venture funds, for the majority, not all, tend to be of a fixed life, and that fixed life is likely to be either side of 10 years. If that particular fund is already in year 6, and the investors have got to realize all their investments within the next 4 years, it's probably not a good time to receive investment from that fund. Now, it could be that you are in a sector where a quick turnaround is possible, but it is something you would need to look at. The next ones I would look at are less numeric and more qualitative. Is if you are in a really narrow vertical, the likelihood is that the number of funds that operate where you operate will be quite small. How do you feel about it if those investors have already invested in somebody you see as a competitor? It could go either way. It could be that you take the view that they've got the necessary technical and market expertise, and you don't feel that there's a risk of confidentiality issues arising. Or you could take the view that if they're backing 2 horses that are very close, you will never really get a fair hearing. That will be down to your judgment, the judgment of your advisors and your non-executives. Another issue is, do you think that these investors are adding more than just money? Do you believe that they've got the market expertise? Is it a fund that's run by experienced entrepreneurs themselves, or is it more of a financial fund that's run by people from a banking background who are looking at the corporate finance opportunities and are more focused on an exit than on helping you grow the business. And the final one, and this is almost a counsel of perfection. There are, of course, some investors whose participation in your business looks like a hallmark of quality. It makes it look as if you've reached a certain degree of acceptance in the industry. It's rare, but it is worth thinking about. And generally speaking, I think right at the early stages, it's less relevant than when you're talking about a Series A or a Series B round. And with that, I'd now like to move on to introduce the negotiation exercise that we've prepared. I hope those of you who are participating will have had the chance to read the very simple case study. I think it provides a fairly realistic outline of what might happen if you're an early stage company looking for that range just beyond where probably family and friends or maybe your university seed fund can help you. Basil has two products. It's in beta form at the moment. It isn't really making commercial sales, to come back to one of the distinctions that Maria Carolina talked about before. It knows from its own forecast that it really does have to raise a minimum of 300,000 euros now. And it's in the fortunate position of having received 2 term sheets from 2 different investors. You are the advisor to the founders, and they've asked you to help prepare them for the negotiation with these 2 investor groups. And your first task is a relatively straightforward numerical one of working out what is the likely financial impact on the business of receiving 300,000 as opposed to 600,000. What impact does that have on the valuation of the business today? What impact does that have on the percentage of ownership that the founders have? That's the first bit. The second bit is you're looking at the non-financial governance terms, and you're asked to advise the founders in the board meeting, which is just about to start, on whether you think the governance terms are fair. Would you propose any amendments? Which ones do you regard as, if you like, BATNAs, walk-away points, and which ones do you think it's simply something you'd like to negotiate? And I think in answering all these questions, it comes back to the point that with a case study, as in life, you can't determine everything up front. You know, it isn't that just because you can put a number in the spreadsheet, it will happen. And you're in the same position advising the founders as you are in your own business. You don't know what might happen in 6 months or 12 months' time. If you accept one offer that only provides you with enough money to get through the near future, will you be able to raise more money later? If you accept the bigger offer but you get more dilution, is that going to limit your freedom to operate later on? You really don't know. So those are the questions. That's what we'd like to break you out into groups to answer. And in a moment, I'm just going to hand back to Edouard for the scene management. But I hope everybody's got the picture. It's a case of break into teams, look at those 2 sets of questions, come back with a prepared answer. And we, as in the EBN team, Maria